Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Josiah Welch. Josiah, go ahead and tell the people a little bit about yourself.
Hey, Troy, I appreciate you having me on your channel. I'm Josiah Welch. I'm currently stationed in Fort Kansas. I've been in the Army for 7 years, and yeah, I'm excited to be on the channel to talk about dividend growth investing.
Yeah. Hey, first of all, thanks for your service. And
Hey,
second of all, so for anybody watching, Josiah actually watched the intro to these interviews and saw that my email was on the interview. And he reached out via email and asked if he could be on the channel, and here he is. So if anybody else wants to be on the channel, use that email, and you guys can hit me up and be on your very own episode. So with that being said, when did you begin your investing journey? And then when you got started investing, did you start with dividends or did you start with something else? And then what got you into the dividend side of it?
I bought my first stock whenever I believe I was 17 or 18. I bought a dollar. It was either Dollar General or Rite Aid stock. And I was obsessed with the stock market when I was a kid. I would read the Stock Market for Dummies book, and then I read The Intelligent Investor by Benjamin Graham. To make a long story short, I got serious about investing in 2020 with Tesla stock, and then I kind of refined my investing strategy in around 2022 and focused more on dividend growth investing then.
So what did something happen between 2020 and 2022 where you decided to transition into dividends, or did you accidentally get your first dividend check and you're like, wait a minute, this is kind of cool, I didn't do anything for that? Or how'd that work?
I started getting really into watching the Berkshire Hathaway shareholder meetings, and I listened to Munger and Buffett talk about stock market bubbles and valuations, and I thought, Tesla's valuation really doesn't make sense here. So I sold it, and my friend who was obsessed with Tesla got really mad at me, and he decided not to talk to me anymore because I wasn't involved with Tesla anymore.
Wow.
And then I got into companies that were producing reliable free cash flow. So it wasn't necessarily all about the dividend, because I think it's more about buying good companies and holding them over time.
So was your friend like Elon Musk or something? Like, why did he get so upset?
My friend was actually, his dad is a financial advisor for a big company in Missouri, and he's kind of a silver spoon family, and his dad was a millionaire. So, yeah, it didn't end well, but, it is what it is.
I feel like that's a weird reason to like not be friends with somebody. Like how
Yeah.
you want to make or lose your money, it matters to me. Like I don't care.
Yeah, so.
Well, that's something. Well, that's a first on here. You lost a friendship over a Tesla stock. I've never heard of that before. So,
Yeah.
okay. So, do you remember this is a not scripted question. Do you remember your first? Like you said, you might have bought Dollar General as one of your first stocks. So, like, if that one wasn't your first stock, do you remember your first dividend stock? Or like, let's just say when you transitioned in 2022 to caring more about like free cash flow and reliable and sustainable free cash flows, do you remember what you were buying?
My first dividend stock would probably be, I don't know if you consider Microsoft a heavy dividend stock. It's more of a dividend growth stock, but I got really involved in Microsoft.
Yeah. I mean, that's good. I had that one too. So I like,
Yeah.
see that's my thing. I know a lot of people, and I am like this to a certain extent. Like some people in some of the Facebook groups I'm part of, they consider like Nvidia a dividend stock, and technically it is, but they pay you like 4 cents a year or something like that.
Yeah.
Their yield is like getting to the point where they're going to have to have an extra or an extra zero in front of the decimal place just to show their yield. But so I don't necessarily consider that a dividend stock, even though it does pay a dividend stock. But yeah, I have like Apple, I have Microsoft, I have Visa, like a lot of these companies that are like really big tech companies, if you want to call Visa a tech company, that pay really low yields. And I still consider them a dividend stock. So I don't know what the cutoff is between like when I care if it is or isn't a dividend stock kind of thing. But technically, if it pays a dividend, it's a dividend stock. So NVIDIA, I guess you're part of the cool kids club. But okay, yeah, so I like Microsoft. That's one I have too. So, okay, so since 2022, or I mean, honestly, you can really answer this since 2020 when you really started. What would you say is your biggest dividend related mistake? And then more importantly than the mistake is what lesson did you learn from making that mistake so you don't do it again?
I listened to a lot of YouTube channels back then, and I didn't incorporate logical thinking or critical thinking when I listened to them. Didn't formulate my own investment thesis, which is dangerous. So a lot of people out there are yield chasers, which is dangerous. You want to focus on whether or not it's a good company and the free cash flow. I decided to buy AT&T, and as I'm sure most people watching this know, they had to cut their dividend because they had to clean up their balance sheet. I'm sure you've seen that with Walgreens recently. So you got to be careful of yield traps. I think the dividend shouldn't be the only reason you buy a company. It should be, is this a good company that is going to grow over time or not?
Yeah, I agree with all that stuff. Like and I don't know, I've seen it asked a bunch of different places is like, what is there a certain number that you consider the yield to be for it to be a yield trap? Or is it kind of all encompassing? Like it requires like really high payout ratio with a high yield and like not good performance. Their free cash flows not high enough to cover the dividend, like stuff like that. I think it's more all encompassing. No?
I think it's dependent on the free cash flow. It also, you read the 10K filing, what is their strategy to grow their free cash flow over time? Like Visa, they have very good strategies in place to grow their free cash flow.
Yeah, because I think a lot of people are looking for like, and me included, like a lot of people try to look for some magic number, whether it's, what is a dividend, like what is a stock that's going to be a low enough yield now, but the dividend growth rate's high enough. Like I'm trying to figure out, like, is there a magic like formula I can figure out that we're like, oh, okay, this is growing at this pace, which means in this many years when I need it, it'll be worth it. Or if it won't grow fast enough or it's going to go too fast or whatever. And then vice versa for like the yield chasers. So like, okay, what is like a 4%? Is that yield chasing, or is it 8%, or is it 12%? Like everybody's looking for that one magic number. And I do think it's more variable than that. There's so many things that go into it, like like all the things that you mentioned. So, I think your interview 35, 36, something like that. And I think everybody that I've interviewed mentioned that their mistake is yield chasing. So, if you're watching this and you haven't went through your yield chasing phase and you haven't identified that you went through your yield chasing phase, you're probably in your yield chasing phase. Like that's what I'm going to say. So, cause we all do it. Like I've owned AT&T, I've owned Verizon. I didn't own them for long. And honestly, I don't even remember the reason I sold them. I think I just sold them because I was transitioning my portfolio, but then going back and looking at it, I'm like, man, I'm really glad I got out of those positions. So, okay. So next one, and you kind of have touched on this already. So what are some of the biggest ways that you've said that you would say your investing style has changed from when you first began investing to now? Like what are things that you look at now that you never even would have considered?
When I first started investing, I'd have to say that I was an idiot. I would buy companies and then I would be like, after a day or two, I would sell them. Kind of fear of missing out. And I didn't realize the implications of capital gains tax.
Yeah.
And I did my taxes on my own through TurboTax the first year, and I didn't know what I was doing. And I had a tax professional the next year review the current year and the previous year because I want to, cover myself from the IRS.
Yeah.
And it turned out that I owed $6,000 in capital gains tax. so I had to pay it. I'm good now. I'm not going to get in trouble, but had to pay the late fee and everything. And I think it's important for investors to, if you don't know what you're doing with capital gains tax, to be careful with that too.
Yeah, well, and that's even more reason to buy and hold. Which
Yeah.
I've discussed this in other interviews. Do you think that dividend investing, above all other kinds of investing, actually incentivizes the buy and hold strategy? Because like the longer you hold it, especially if you have a good stock with a good dividend growth rate, you're getting that capital appreciation. You're also, the longer you hold it, the more it's compounding. So I think that's what it does, and that's, in my opinion, a good thing.
Well, I think it's very advantageous whenever you can buy and hold a dividend growth company in your Roth IRA.
Mm-hmm.
This year, I've almost maxed out my Roth IRA. The limit's 7,000,
Mm-hmm.
and I'm putting 100% of my buying this year into Visa because I think Visa is going to grow their dividend. They have I think it's about a 16% CAGR rate.
Yeah.
So yeah.
Yeah, I own Visa. And so my strategy, and I don't know that there's a right or wrong way for this. My strategy currently for my Roth IRA anyway is I only hold ETFs and Tesla in there. The idea is that I want it to be more hands off. And then Tesla is, in theory, the bigger growth company. So like any of the gains that I get in there are tax deferred. So that's really nice. And then all my individual holdings, which is what I share in my monthly recaps and stuff, that's all in my taxable account because that's the one I'm going to need to retire early off of. So, do you do any investing outside of your Roth IRA, or is it just get your Roth maxed out first and then a taxable, or how's that work?
Oh yeah, I do a lot of investing outside of my Roth IRA. I have individual brokerage account and Robinhood, and then the biggest individual brokerage account would be in my Charles Schwab. I actually left Robinhood because they didn't have a Roth IRA, and then about 6 months after I left, they created the Roth IRA.
Yeah.
So
Well, hey,
yeah,
I think they have a transfer, and I don't know if it works for like
yeah,
previous customers, but if you transfer your Roth, then they give you like a match or something. So
yeah. So if we could touch on that real quick, they did that promotion, and within about a 6 month period, they went from having about less than 1 billion in retirement accounts. Now Robinhood has 4 billion total in assets under management in their retirement accounts. So Robinhood has really made a turnaround since that 2020 debacle.
and I've said this in hundreds of other interviews, even though I've only done 30 something. I think Robinhood gets a lot of slack, whatever the word is, like a lot of
Yeah,
crap for like some of the stuff that they did wrong. But to me, they're in a very volatile space. They're dealing with people's money, which people are really like up in arms about, rightfully so. So like any little thing they do, and they're like a little guy coming into a big guy space, right? Like they're messing up other brokerages and other financial institutions. Like they're coming in here trying to be the disruptor. And for what it's worth, I think Robinhood is like very necessary because they seem to be like the pioneers of trying things. Like they have a couple stocks that are open for 24-hour trading, and I've said that for the last 2 or 3 years, where I think the markets are going to go to 24 hours, because crypto does. And people
yeah,
see that people literally will trade Bitcoin or whatever else. They'll do that all day, every day. Why would the stock market not do that? There's
yeah.
no
And
such thing as holidays or stock market closed or anything like that.
they pioneered the commission-free trading,
Mm-hmm. Yep. Fractional
which
shares, like all kinds of stuff
yeah,
like that. Yeah. So I think they're really good. And whether they work out in 10 years or not, I don't know. Like it's hard to say. I personally like them. I haven't used Robinhood in a very long time, and I know I have a Robinhood crypto account, which literally has $50 in Bitcoin and $50 in Ethereum, and I can't bring myself to buy more of either of them because I'm like, okay, would I rather put $100 in this crypto or $100 into Visa or Apple or Microsoft or
yeah.
one of these? And I'm like, I can never do that. Like I like these other companies more. So, and I understand them more. So, that's my big thing. But all that to say, I still have a Robinhood account, which is the only reason I know of some of the changes. And Robinhood's changed a lot since I was using it. Like now there's like and you look at like an ETF, it breaks it down by like, there's like a little bar thing and it tells you how much is in each sector and all kinds of stuff. And like that didn't exist when I was on Robinhood. So some things I feel like they are on a delicate balance where they're trying to add a lot of features, But also the big draw to me over Robinhood, or with Robinhood over something like a Webull, is how simple it was. Like it was, if you couldn't figure out Robinhood, then you can't figure out anything. Because like
Yeah.
Robinhood back in the day was like idiot proof basically. So, and then I went over to Webull because somebody else had like, oh, get free stocks on Webull or whatever. I went over there and I was like, well, what am I like? What are all these numbers and stuff? What am I looking at? So it was really confusing. But yeah, I don't know. For what it's worth, I think Robinhood's pretty good. So if you're investing with Robinhood, don't let people talk you, not you specifically or anybody watching. Like, don't let people, shame you into investing for Robinhood. The most important thing is not where you're investing, but that you're investing. So
Yeah.
okay, so I'm curious this for you. So what are some of your short-term goals with investing or with your dividend portfolio specifically? And then what are some of your long-term goals? Like, do you hope to one day live off of the dividends? Some people just want it as like a, vacation fund every year where they get paid, $4,000 a month or $4,000 a year in dividends. They use it for vacation. What are your plans?
I don't know. I enjoy working, so I would like it to be where I'm able to retire, but I have the option to keep working.
Mm-hmm.
Maybe working for myself, maybe buying some real estate. Um, as a short-term goal, I just want to be more financially independent. I feel like in America, as a worker or an employer, your goal in life, pretty much as an employer or an employee, is to make whoever is in charge of you happy.
Mm-hmm.
And that can be really subjective. Like, I've had bosses that think I'm amazing and I do the same exact thing, and the next boss switches out and they can't stand me and I'm doing the same exact thing. So I kind of get tired of the rat race of that.
Mm-hmm.
And then a long-term goal, I would like to become very wealthy, and I'd like to give a lot of it away to charities like Feeding America and helping the homeless and people in poverty. I think wealthy people in America often get attacked for being greedy and get hated on a lot because people think that we're in it for ourselves. But I think it's Paul Tudor Jones. I'm reading a book about the holy grail of investing. He's given away about $3 billion to house the homeless. So yeah.
Well, yeah, I a lot of people see that where they're like, Elon Musk or whatever, or Bill Gates or whatever, and not even bringing anything political into it, but like they see that they still have a lot of money and they assume that they never gave anything.
Yeah.
And I'm just like, that's not like, what do you want them to give all their money away? Like, then they wouldn't be able to do the things that they do because then they would be broke. Like, then what? Like, then, so I agree with what you're saying where like there's a delicate balance between like being able to make a lot of money and being like people seeing you as being greedy. But in order for you to ever get to the point where you can give away like you want to, like you have to get to that point first.
Yeah, I've received a lot of hate from some family members because they think that I have some bad motives for wanting to become wealthy. And, it's investing is kind of a rough hobby or even a profession because, like, if you're into golfing or fishing, nobody's going to attack you for trying to show off but investing involves money. So people are going to get jealous. They're going to get envious. It's tough.
Well, like, so I never understood that because like I see so many people, I feel like they would rather come up with an excuse of why they can't than use that same brain power to actually figure out how they can. Does that make sense? Like I know people personally that are like, oh, I can't invest, or oh, it must be nice to invest, or I can't do this, I can't do that. I'm like, you just thought, you spent, 10 watts of energy. I don't know how we measure brain waves, but you spent 10 watts of energy to think of all these excuses of why you can't do this. When in reality, it would have taken you half as much brain energy to figure out, okay, how can I save $10 a month and start investing that? Like, that's why I started that Anyone Can Invest series, is exactly that reason. It's $60 every paycheck. That's it. Like, if you can't do $60 every paycheck, I don't like, literally that's eat out once less per week or something like that. Like, it's super simple. Everybody can do it. And I'm sure there are, few and far between situations where somebody's genuinely, they are pinching every penny and they're barely making it. I get it. But like in most cases, I feel like, I don't know if you've ever seen the YouTube channel, Caleb Hammer. He does like financial audits where people fly to, I think it's like, Austin or something like that. Austin, Texas, and they'll sit down with him and like he goes over their finances and he just looks at like all their bank statements and stuff and he's like, you spent 23% of your monthly spending on just crap, like just you went to Chipotle and Chick-fil-A and all this stuff, and they're like, that's where your money's going, and you say you have no money.
Yeah, and I haven't seen his channel, but I'll have to look it up. I appreciate it. Um, but I think my pet peeve is people that they attack their landlord or wealthy people that they know, and they get mad at them, and they think that they play the victim.
Mm-hmm.
But I started out homeless, and I got a six-figure net worth now. Instead, and these very people will spend money on concerts, on sporting events, but they won't invest in good companies, So
It's priorities. That's what it is.
Yeah.
And the sad part is their priorities typically, I don't even want to say typically, sometimes their priorities will change. And by the time they change, it's not necessarily too late, but they made it a lot harder for themselves. Like people don't even think about the R word, the retirement word. They don't even think about that until they're 50. And then by then they lost the best two to 3 decades, your 20s, your 30s, and your 40s of compounding. I mean, they get progressively worse as you go. You lost those because you were like, retirement's for old people. I don't need to worry about that till later. And then when they look at the numbers, they're like, oh, okay, well, I could have invested $100 a month back when I was 22 and I could have had $1 million. Or now that I'm 53, I need to invest, $3,600 a month to get to the same result. And I'm just like, that's what they're not understanding. And no matter how much I preach it or talk about it, or we talk about it in these interviews or whatever, how many articles you see or whatever, like it just doesn't click for some reason. Like for me, I'm 29. It is hard to forecast for retirement. Like I'm trying to predict literally like my whole life, double that. I'm trying to predict that far ahead, like twice as long or as long as I've lived. I'm trying to just, okay, in the future, in 30 more years, I want to do this. I haven't even been to 30 years yet. And I'm trying to predict that long. So I get it, but yeah, it is a pet peeve of mine as well with the whole, everybody thinking that rich people are bad people. And my counter to that is typically going to be like something like, okay, well, why don't you work on getting rich and then change the narrative? Like, why don't you be a good rich person?
Yeah.
Instead of playing, woe is me, I'm the victim kind of thing. So yeah, I agree with that. I don't know how we got on that, but I agree with what you're talking about.
Yeah.
Okay. So actually, question on what you were just talking about. Do you have, anybody in like your immediate circle, whether it's, is that the, like a barracks that you're on? Is that what you call those?
Yeah. Yeah.
Okay. So yeah, I know I've heard the word barracks before. I felt like that was what it was called, but so like, do you have people that you work with that are into investing, or do they not care? Or, like, do you have friends and family that talk about it? Or are you like really the only, it seems like I'm like one of the only people in my tight circle that even care about investing.
Well, I got people that hear about my investing and they're all curious. I always tell them to caution them to talk to a licensed professional because I don't want to get sued or anything. But I do have a guy I work with. He's in my firing battery. He's got $500,000, and he was homeless before he joined the Army as well. And me and him are trying to go to the annual meeting, Berkshire Hathaway, to see Warren Buffett on May the 4th, because it's only about 2 hours away from Fort Riley, Kansas, and Omaha. So we're gonna try and go on May the 4th on a Saturday. So
yeah, that'd be cool. I wouldn't mind trying to go to. I mean, as bad as this is to say, I'm also being honest. Like, you don't know how many more of those we have left. So I wouldn't mind. I don't necessarily agree with everything Warren Buffett does, just because, like I said, I'm not super into like. I feel like he has perfected his craft. Not to say it won't work now. I think it could work. I just don't have the patience for that to work. Like we were talking about before the interview. I just want to identify good companies and buy them when I see them, and just keep doing so. Where Warren Buffett literally just waits for like the perfect opportunity. And if it never comes, he's already uber rich anyway, so he doesn't care. Like he has Warren Buffett, I feel like, could spend like $1 billion a day for the rest of his life and not run out of money. Like, yeah.
Well, Berkshire Hathaway has $167 billion of cash on the sidelines. I think they would be more well suited to invest in a good dividend growth company. I feel like they're missing out on the compound interest over time, and they're losing money to inflation. But I don't
So
know.
do you think, so I have Fidelity as my brokerage. The default cash position in Fidelity is SPAXX. I think currently at the time of recording, it's like a 4.96% interest. Obviously, that's yearly, but 4.96% interest. Warren Buffett has to have his money in something like that, right? Like it's not quite literally just cash like sitting in a briefcase in his office, right? Like you think he's getting interest on that?
Well, he talks about having, I think, Greg Abel, who's going to be his successor, buy T-bills every day, Treasury bills. But I'm pretty sure the 167 billion is a line item on the 10K filing, so I'd have to look into it.
Yeah, I'm just curious because like I have my emergency fund in SPAXX. It's only like 17 grand, but I'm getting basically $70 a month just for free. And I just use that $70 a month to like add to my contributions that I can then invest the following month. So it's like free money.
Yeah.
And I'm just like, man, that's on $17,000. This guy's got a lot more commas in his. I wonder what his little interest payment would be. That might be a video idea, just out of fun. But like, hey, Warren Buffett has this much cash at this interest rate on SPAXX. Warren Buffett's making something ungodly per month in interest. That'd be pretty fun. Okay, so I always have to set this question up. I feel like I don't need to, but I just do. So dividend investing is a long game, right? So like it's not a get rich quick tomorrow. You're not going to make an Instagram reel with your driving your Lamborghini with a really nice watch tomorrow, unfortunately. So with it being a long game, are there any dividend milestones that you've achieved, or like milestones or achievements that have recently happened to like really help you like keep you motivated? Like, do you track like your forward income that you're supposed to get, or how much you've received so far year to date in 2024? Do you track stuff like that?
Yeah. So it's been a while back, but I finally hit 1,000 a year in dividends.
Nice.
And now I'm around 1,800 a year in dividends.
Is that your projection, or is that what you received like in 2023?
2023, I believe I received 1,500 in dividends.
Oh, okay, cool.
I'm not a yield chaser, so I mean, I'm very patient with how much in dividends I'll get over time. To me, it's more about buying really good companies.
So do you keep track of, like, if you were looking at a company and pretend company A, they both have the same exact balance sheets, but company A has a 0.5% dividend yield, a lower payout ratio, let's just say 20% payout ratio, but they have a dividend growth rate of 15%. Or you have company B, again, same exact balance sheet, just pretend their payout ratio is also 20%, but they have a 4% yield, but they're only growing their dividend at 4% a year. Like, which one do you prefer at this point?
I think I did make a decision about that recently. United Healthcare. I used my tax return and my individual brokerage account. I bought around, I think 3,300 worth. They have a very low payout ratio, but they have a 16% compound annual growth rate for their dividends. So United Healthcare, I made that decision. I'd rather have a management team and a company that is able to grow their cash flow good over time, like a Home Depot or United Healthcare.
Well, yeah, and the thing, like, I don't really dive into a lot of metrics and stuff like that. Like, I'm sure you've heard me talk about in other interviews. Like, I like to, a lot of that stuff confuses me. Like, even when you're looking at a balance sheet and it says like in billions and then it lists a number with like decimal points, I'm like, okay, this is like already, like, just give me all the commas and zeros. Like, I want to see all that stuff so I can actually see what number that is. So like stuff like that confuses me, which I'm sure I'm not alone. So my question was, when I was creating my criteria to judge my stocks by, is like, how simple can I make my criteria, but it also encompasses some of the things that are more complicated that you and others might look at. So like mine is like outperforming the S&P 500, the dividend growth rate above 10%, and a dividend streak of at least 5 years. All those things, like, the weird thing about it is when you look for a stock and you're identifying stocks that you really like with all the numbers that you're looking at, they're the same stocks I like. I'm just getting like, it's, whether you're doing 2 + 2 to equal 4, or I'm doing 1 + 3 to equal 4, we get to the same result. It's just different ways to get there. So it's really cool to do stuff like that. And it's, I just like the dividend growth rate to me is I think just one of the more important things. I was talking in another interview. I'm not sure if it went live already, but like I don't know how we make dividend growth rate cool. Everybody always wants to know like what's the yield of your portfolio or something like that, or how much you're making a year or whatever. How do we make like, hey, what's your dividend growth rate for your portfolio? Like how do we make that cool?
Yeah, because that speeds up the compound interest.
Yeah.
Uh, I always say, to me, my number one metric I look at when investing, which I have, I got to look at the overall because you got to have common sense. But the biggest metric I look at is CAGR, compound annual growth rate, and I think it's Macro Trends. That's a good free website you can look at for that.
Yeah. Yeah. I like, and you're talking about like the compound annual growth rate of the company in general or the dividend?
Both.
Yeah. Yeah. Cause
Yeah.
I mean, and the thing that I can say with, the people that oppose dividend growth rate is just because, United Healthcare has a 16%, 3-year dividend growth rate doesn't mean that next year they're going to raise their dividend by anything close to that. They could raise it by 4% next year. Like we don't know.
Yeah.
But one thing that you can look at that like just, history doesn't determine future, but like it's a good indicator kind of thing is if United Healthcare always has a payout ratio about 20% and they were to grow their free cash flows and stuff like you're talking about at the same rate, how do they keep their payout ratio at 20%? Like what would the percent raise be? And then you can kind of figure out where their next dividend's going to be. So, or companies will announce it. Like I have NextEra Energy. They've already announced for I think it's 25 and 26, they're going to raise their dividend by 10% each year. Which NextEra Energy is one of my biggest losers. It's actually starting to make a little bit of a comeback, and I've been adding the whole time. So like I'm getting over here, lowering my cost basis while getting a 10% raise on my dividend, just because. So whenever it finally does kick back, and like I went from a cost basis of like I don't know 80 something, I'm just making this number up, like 80 something. Now I can get my cost basis down to like 65, and then when it goes back up to 80. Now I'm good. Now I'm $15 in the green on all the shares that I got. I got a bunch of shares for cheaper, and I'm getting a 10% compound annual growth rate. So you got to like that. So, okay. So next question for you, and I'm curious this because of your goal, your end goal, your long term goal to be to get a lot of money and then be able to donate it, or donate at least some of it. How and when will you know when enough is enough? So like when you're over here building your portfolio, especially with you being the kind of investor you are, where you like compound annual growth rates. You're going to know, especially when you get closer to the time, if I'm making $86,000 a year off of dividends now, if I wait one more year, that could be $97,000. And if I wait one more year, that could be $110,000. Like the closer you get, you can start to forecast that. So how will you know, like, okay, this is, I know it'll go up next year, but I'm okay with this number. How are you going to get there?
That's a good question. That's not something I put a whole lot of thought into.
Because that's my thing. Like, right? Like, it's literally that. You know how when you run your numbers right now and you're like, oh, okay, in 36 years, and it's going to grow at this much, and you're going to see that your little bar chart go up and to the right, and it gets really big towards the end. It's obviously hard to predict that far out, right? But the closer you get, the more realistic those expectations become.
Yeah.
But it doesn't necessarily mean that the projections were wrong in the beginning. And like it's just like Warren Buffett's net worth. I know you've seen those charts where like up until this age he had like this, and then since like the last 10 years he's like quadrupled his net worth or whatever. So it's the same thing with your dividend portfolio. So it's something I've had to really think about. Like what number am I going for? Like what's the end goal? And it's not like, once you get to this number, you're done investing. It's just like, okay, maybe you can take your foot off the gas once you get to this number and let the portfolio do its thing, but I can also start enjoying life a little bit.
Well, something I've also thought about is restructuring my will to where a great majority of it goes to a charity whenever I die.
Mm-hmm.
I don't know if you've heard the story of Ronald Reed, the janitor.
Yeah.
Yeah, he didn't really give away his money whenever he was on on Earth, but he gave half of it, I think half to a hospital and half to a library, but he willed it out. I think he had around 8 million. So yeah.
Yeah, and that I think is just personal preference for a lot of people because like he never really got to see his money get used, and that would bother some people. Like that, I'm on both sides of that because like it would be nice to just like use my money how I want to use my money while I'm alive. When I die, will it to like I have a kid, so like I don't want him to, not get any of it, but also I tell he's only one, but I tell him all the time, I'm like, hey, I got money, you're broke. Like you got no money, but I got money. So but like and he actually has his own investing account, all kinds of stuff. But like it would be so the good side to that is he got to use any money that he wanted to use while he was live. That guy was really frugal though, which is why he was a janitor and able to get as much money as he did. So I can't imagine he was, going on Bahama cruises when he was done. But he got to live his life without having to worry about money and running out of it because you never know how long you're going to live. But then when he died, he never got to see his money get used. And then on the flip
Yeah.
side, when you donate your money, like sometimes, what if you're over generous and you're like, oh crap, I gave away too much money. Now I need to go back to work at 86 because I'm broke. Which is cool because
Yeah.
you get to see your money get used, but then you do have that risk of like, oh, now you really got to put yourself on a budget because you could run out of money if you go over that or something. So it's a catch-22, I guess.
Yeah.
Yeah. Okay. Yeah. So that's just a question. So the question like of figuring out like how and when do you know enough is enough. So you might be able to use this too. I mean, we have a little bit of different goals, but like my goal is 110% of my expenses at the time. But my expenses include my investing money and my saving money. So like it's not like, oh, okay, like I have $3,000 a month in expenses. Cool. But I have $2,000 a month that I want to invest, so that puts me at $5,000, and I have $1,000 a month I want to save, which puts me at $6,000. So $6,000 a month is my goal, and then 10% more than that, which will still allow me to invest and save and pay my expenses. So like that's kind of the way I'm thinking of it. Because the 10% is just like the buffer. If something comes up this year that I wasn't expecting or whatever, I'll have the money to cover that. And I honestly plan to keep doing the dividend growth style, just because that it outpaces inflation. So like I won't have to worry about inflation at 2, 3, 4%, whatever it is, if I'm making 10% on my money.
What are your three biggest holdings?
Probably Apple, Microsoft, and Visa. My sneaky holding that is I'm trying to get to become more and more of my portfolio is Pool Corp. A lot of people have never heard of that.
Yeah, I never have.
Yeah, so if you look up the actual like numbers behind Pool Corp, that thing is it's such a sneaky good company. I think they're growing their dividend at 16% a year. They outperform the market. Their dividend, I forget how many years they've been paying. I want to say it's like 14 or 15. I could be wrong on that. But yeah, that's my top three are those. Pool Corp is either fourth or it might be sneaking in the top three. I don't know. I'm trying to. This year's my first year doing the active and dormant strategy. So in these interviews, because I learned a lot of things too from these interviews. In the interview, one of my people that I talked to, he said that his biggest regret in the stock market, and this guy's lived a good life, like he's in his older years, and he was mentioning his biggest regrets are selling. He goes, even if
Me
it's
too.
so he was like, even if it's a stock that he lost a little conviction on, he goes, I would just rather hold it. Don't add more money to it. Just hold it. Just keep it there.
Me too. I mean, it depends on the situation though, but
Yeah.
yeah.
Yeah. So that's kind of what I'm doing. So my active and dormant strategy is just that. It's the first year I'm doing it. But Starbucks and ExxonMobil, when I reviewed them at the end of 23 or beginning of 2024, I forget which one, but when I reviewed them, they were underperforming the S&P over the past 10 years. And that when I feel like this is underspoken about in the industry. It's important to have criteria, but the second most important thing about having criteria, other than like following it and sticking to it, is like in my mind ordering the criteria. Because if everything's important, then nothing's important, kind of thing. Like how when you're, I mean, in my situation, when I'm at work, if everybody's sending emails and they're all marked as high importance, then I can't work on any of them specifically because everything's important apparently. So like, it's the same thing with my criteria. But to me, the most important is the bang for my buck, which is the outperformance of the S&P 500. Because if not, I might as well just invest in the S&P 500. So like, that's my thing. And both of those weren't doing it. So I'm putting them on hold. I'm letting them drip, but I'm not adding any money to them.
I'd actually like to talk about the S&P 500 if that's okay.
Yeah, go ahead.
I think the S&P 500, there's a lot of logical fallacies there with the investment industry. So have you heard of Peter Lynch?
Mm-hmm.
So I've read his book, One Up on Wall Street, how he believes the retail investor has an advantage to outperform the S&P 500 because by law, hedge funds and institutional investors can only allocate a certain percentage of their assets under management into a certain company.
Mhm.
Retail investors can put any percentage we want into like a Visa or a MasterCard or any NVIDIA, to where it is very possible for the retail investor to outperform the S&P 500, is what Peter Lynch was saying in that book. Obviously, if you're listening to this, talk to a licensed financial advisor. But me personally, 32% of the S&P 500's holdings are in the Mag 7.
Mhm.
To me, that if those Mag 7 stocks start to underperform, the entire S&P 500 is going to go downhill. It's kind of I think the S&P 500 over the next century isn't going to be the benchmark that it's always been.
Do you think it'll switch to something like the Russell or the Nasdaq?
That or the QQQ.
Yeah. Yeah. So I mean,
So
I don't necessarily disagree with that. The only thing I would say is that like the S&P 500 is it's not static. So like as times change, it changes too. So like if it starts to see Microsoft does, something different than Microsoft's been doing over the last, 30 years or whatever, it'll because I think Microsoft's the biggest holding in there. It's either Microsoft or Apple. I think it's Microsoft. But like as it starts to change, then it'll start reallocating some of that money. Maybe there's whatever that SMG, the micro whatever. It's like another Nvidia. It's another chip company, microchip something. That thing's been killing it lately, and I could see that becoming a bigger portion because I was just doing some research on the S&P 500. The smallest so there's 503 companies or 503 holdings. Technically, it's only 500 companies because there's 3 companies that have like Part A, Part B shares or something like that. Class A, Class B. Like News Corp, Fox, and I forget what the other one is. I don't remember. But yeah, so it holds those, which is how there's more than 500 company or 500 holdings in there. But like News Corp is the bottom, they're 0.1%, which is obviously makes sense because if Microsoft's 7.9% of the S&P 500, first of all, you can't have everything at 1% anyway because there's 500 and there's only 100%. So like things need to be less than 1% just by default. But then it gets even more crazy because you do have holdings that are over 1%, such as Microsoft, your Apple, your Nvidia, your Tesla, your stuff like that. So yeah, I don't know. I think for the everyday person, I get what Peter Lynch is saying. The hard part is just like relying on the retail investor to pick the right stock to begin with. Because like
yeah,
if that person decides, oh, AT&T is the one, and then they're just going
yeah,
to sit there and underperform for the next 10 years, then what happens?
yeah. I I don't know. I think the S&P 500 gets put on a pedestal, but at the same time, when I see people that are new to investing, their holding period is like less than a month,
Mm-hmm.
and they're just buying whatever's exciting and new. So I don't know. I see both sides. I know Charlie Munger has talked about
Mm-hmm.
diversification.
Yep.
He always said that he wanted the majority of his money to be in Berkshire and Costco.
Mm-hmm.
So.
Yeah, and that's I talk about that all the time. That's actually a question on here. So like, how do you handle diversification? Like, how many holdings do you have? Do you have a little bit more holdings than you want? Or are you trying to add more holdings? Where are you at?
So the majority of my money is in Apple, which I think is kind of risky. I've got 44,000 in Apple, and then it goes Home Depot, several thousand on Home Depot, Microsoft, Lowe's, United Healthcare, and then I want Visa to eventually be my number one holding. I'm kind of concerned about Apple, but not to the point to where I'd sell it, because I don't know if you've heard, Apple's had a lot of
Mm-hmm.
issues surrounding the company. I don't know if it's gonna hurt the company long term though. So
I mean, it's like the DOJ or whatever. They're going after all the big tech. Like they went after Meta already. I think they went after Microsoft and they went after Amazon. I think was the other one. Um, the stuff that they're bringing to light for Apple, a lot of like you can tell that the DOJ has been working on this case for a long time because a lot of things Apple's already addressed. And to me, I just don't see a world where Apple doesn't exist. Not to say that it always will be like the superpower of the stock market or whatever, but like that people, I have an iPhone and I have AirPods. Now that's as far as my Apple ecosystem goes, but I know some people that literally have every piece of whatever Apple makes. They have a MacBook, they have iPhone, they have the goggle things, they got the watch, they got AirTags, they got the whole 9 yards, they got a TV, the whole thing. And like I don't know, I just don't see it going anywhere. Like I said, Apple's one of my biggest holdings too. And at the end of the day, like you said, it's not about selling. Like it could be like, okay, I'm losing conviction, or actually, the next question is like, what specific criteria do you have when selecting your stock? So it could be the same thing, like ordering your. It's important to have the criteria, but also ordering the criteria. And if you put your criteria in a certain order, and Apple starts to fall off of that number one thing where it's like no exceptions, like this is the thing that it needs to do, then maybe you put it on hold. You can do like an active endorment strategy as well, because like selling, $44,000 of Apple, I don't know, that sounds like you said, you're not at that point yet, but I don't know. I just wouldn't bet on Apple. I feel like more money would go on the side of Apple doing well than Apple doing not like doing poorly.
Yeah, I'm not gonna sell it because I don't want to pay taxes
Yeah,
on it.
yeah, yeah.
Yeah,
And that's in your
I got a
taxable
good.
account, right?
Yeah, I've
Yeah,
got a good margin of safety on it. So
yeah. My everybody was freaking out about Apple's recent drop because I think it was close to 200 at one point, and then it fell back down to like the 170s. And people were like, "Oh, a couple of groups I'm in on Facebook, they were worried about it and stuff." I was like, "Oh, I'm going to keep buying it. Hopefully, it goes down low enough so that I can keep lowering my cost basis." But my cost basis on Apple is like 160 or something like that, 165, something like that. So like it's still above my cost basis, which is cool because like now when I buy like my little bits every day, instead of it going up by like 5-6 cents every time I buy, now it's going up by like a penny, or maybe I'll buy it 2 days in a row and it won't go up at all, kind of thing, because it's getting close. But at the end of the day, like I tell people this all the time because a lot of investing is psychology. Like when you were just talking about the S&P 500, the psychology is people are more likely to buy and hold ETFs than they are individual companies, because nobody's ever like, oh, the S&P 500 as a whole is doing this. They're always like, oh, this thing within the S&P 500, this Apple or Tesla or whatever. And then if you own those individual companies, like you just said with Apple, then you start getting a little finicky because they're directly calling out your stock.
yeah,
And I feel like that's the advantage, is the psychological part of the S&P 500. People just buy and hold it for long periods of time, and that's what causes them to outperform versus the flipping and selling and tax loss harvesting and all kinds of other words that they want to throw around to make themselves feel good. So,
I just read Warren Buffett's annual shareholder letter, and he said always ignore the pundits. So I
well,
don't know if you
yeah,
watch
there's
CNBC or not.
yeah, exactly. There's so many good sayings and stuff like that. And then he always has the like when the tide goes out, you get to see who's swimming naked kind of thing. So like it's
Yeah,
always one of those things. Like when the market's good, that's cool. But like when the market goes bad, you get to actually see who knows what they were talking about or who are just faking it. So so going back to the criteria thing, what are some of the criteria you have? Do you have like 20 criteria? Do you have like 4 criteria? Like what are they?
the I've heard Kevin O'Leary quote Charlie Munger a lot, and it's the quote: "If it has no cash flow, just say no."
Mm-hmm.
The biggest criteria for me is cash flow and the net profit margin. Visa's net profit margin is, I believe, 53.92% for 2023, and according to NYU, the average across all industries net profit margin of companies is around 12%. So, 12% compared to 53% is pretty big. So, companies that Peter Thiel says he likes to invest in monopolies.
Mm-hmm.
Obviously, not a monopoly that is has criminal charges against it for being a monopoly, but something that has postured itself as a monopoly. Um, like Visa, I don't see Visa going anywhere anytime soon. They read their 10K filing. They did 14.3 trillion worth of transactions on their cards last year. So yeah,
Well, and I think there was just something I read the other day. I'm not a really big reader. Like I'd rather watch things than read. I just can't focus long enough to read. But um, I actually read. Technically, I didn't read it. So my computer, when I get an email, I can just highlight it and say read aloud and it reads it to me and I just like follow along kind of thing. Maybe I'm a kid, but whatever. But anyway, I was listening to something be read to me where they were talking about the fees that MasterCard and Visa charge and how those they're like putting a cap on the fees or lowering the fees or something like that. And they're making it sound like it won't necessarily impact the consumer as much as it will the banks, because the banks are the one that actually get the fee. So I'm assuming Bank of America, say they use Visas. I don't know what they use, but say they use Visas. Bank of America is getting, they pay for the right to put Visa or to use Visa as their card, which is where Visa is getting the money from Bank of America. But then the 2% charge that the grocery store gets charged for every time you swipe, that goes to the bank. So they're getting like residuals, almost like a dividend, basically, off of every transaction that you swipe or whatever. So, but my grocery store in the area, like this is a smaller like employee-owned grocery store, they stopped allowing credit cards. Like they don't allow credit cards anymore. You can still use a debit card, but they don't use credit cards, which is annoying because I'm missing out on my points. But yeah,
that's
so
bizarre.
That's the thing with that. So it's a catch-22. So hopefully with this new fee thing, the fee structure and stuff, hopefully it becomes more advantageous for more grocery stores and stuff to actually allow credit cards so I can get more points. But I'm not the one, I know Dave Ramsey says I've never met a billionaire or a millionaire, brag about their credit card reward points. But like, if I'm going to spend the money anyway, one, there's advantages to credit cards as far as like, fraud protection and stuff like that. But then two, like, why would I not want 2% cash back on money that I was going to spend anyway? I'm not seeking out extra things to spend money on, but I'm getting 2% back. I wish I could pay my mortgage with my credit card. That'd be great.
Well, I actually do know of millionaires and billionaires that use credit cards and they pay them off. Mark Cuban talks about it, and Kevin O'Leary. So Dave Ramsey has a lot of good points, but I think everybody should come up with their own thesis on their finances.
Mm-hmm. Well, and that's one thing that's really hard too, is like you got to figure like somebody's new to the investing game. They come in, they listen to this guy and this guy and this guy and this guy, and what ends up happening, and not even that everybody should have like the same ideas. That's not how it should work. But the thing that's really hard is like somebody doesn't know anything. They listen, like say you have a different point of view than I have. I'll make my case. It sounds really good. You make your case. It sounds really good, but they're opposing points of view. And then that person that comes in and they're in the middle, they're just like, okay, I effectively have not moved because I agree with both of these guys. Like they both make good cases. So like, it's the same thing with like Mark Cuban might have a completely different idea than Dave Ramsey. And like, if you take what you think of the person out of it, because like some people might not like Mark Cuban, some people might not like Dave Ramsey, but like if you just listen to the things they say, if you agree with both of them evenly, like you're effectively doing nothing because like you're like, all right, well, they both say the opposite thing. If I'm pulling left and pulling right at the same pace, I'm not going anywhere. So I don't know. It does get difficult for new people, and I think we all had to go through it too. When you first start learning, like you'll hear something, you'll get really convinced, you'll start doing that, but then as investing's cool, and I think it's like this in life in general, but investing specifically. The more you know you don't know kind of thing. Like the more you learn, you're just like, man, there's so much more of this that I didn't even understand.
It sounds like the Dunning-Kruger effect.
Yeah, it is. It's wild.
Yeah, I think real quick, I think one of the most important things about investing qualities is the ability to think critically. Peter Lynch, Carl Icahn, and Peter Thiel, they all are philosophy majors. You would think that they would have prioritized getting a finance or a business degree, but they all decided to major in philosophy.
Well, yeah, and a lot of it's like the emotions behind the market too. Like that matters so much, and people are just like, I feel like that's one of the things that's made me. I don't even want to call it successful, but for lack of a better word, like successful in investing, or at least a decent investor, is the fact that like I'm generally able to remove the emotions out of it. Like when Apple went down, I was like, cool. Like I was going to buy it, whether it was 200 today or whether it's 170 today, it doesn't matter to me. My goal is I have 30 shares of Apple. I want to have a lot more shares of Apple than I have today. And also I think Apple will be worth more 30 years from now than it is today. The only way to get more shares of Apple is to buy more shares of Apple. And if I think it's going to go up in value, why do I care if it's one? If I'm worried about it being 170 or 175 today, that's not a company I want to be invested in anyway. Because I want it to be 3, 4, 5, 10 times that in 30 years. Like I don't want it to be, oh yeah, now it's 200, but if I would have bought it at 170 instead of 175, like I'd have this much more dollars. I don't want to care about that.
Yeah.
So like that's another feather in the cap of what I always say about like stock price doesn't matter as far as that. Like it matters a lot more the closer you get. But like for me right now, we were talking before the interview about Costco. I don't care. Like it didn't matter. Like if they were like, oh, Costco is good value at, $4.80 and I bought it at $4.94, like, oh, at $14, it's $7.20. Who cares? Costco, unless providing they don't do any splits, what's to say in 20 years Costco isn't $2,500 a share? Why do I care the difference between $4.90 and $4.80? I don't care.
Yeah. How much time do we have left?
No, you're talk as long as you want, man.
Okay. Can we talk about yield on cost?
Yeah, go ahead.
Yeah. So, people will chase yield like a Walgreens or AT&T, but I saw a YouTuber break it down last summer, and it was kind of mind blowing, like a light bulb above my head. You look at a company like Visa or MasterCard, yield on cost, you buy it at a certain price, but it looks like a very low yield on paper. But as they grow their dividend every year, you bought it at a low price. So you have a higher yield than what the starting yield is for people that are just now buying it. So there's companies that you could buy at for instance, 3% yield. But as you hold it over a 10-year period and they grow their dividend over time, the yield on cost, you could be yielding 10%. And that's why I think stock investing in good companies is more advantageous than buying like treasury bonds or CDs, because the yield on cost factor, I think the majority of Americans don't even know about the yield on cost.
I've done I think it was one, it might have been two interviews. I know it was one for sure where one guy interviewed, actually, he thinks yield on cost is a bunch of crap, which is, that's why I like doing these interviews. Cause like, I actually like hearing the different points of view. And
Did he tell you why?
Yeah, I forget. It was a while back. If I can remember which one it is, I'll send it to you in an email or a text. Yeah. I'll let you know. Because he explained it, why he believes it. But like, so that's the goal with my portfolio. And without going into too much detail and taking too much time, like my idea is I'm going to build my positions with the companies I want, regardless of their yield. My companies are growing their dividend and they're growing their capital appreciation year over year over year. In 21 years, when I plan at 50, when I plan to retire, if at that point, and I won't even do this with my whole portfolio, but if at that point my yield on cost and or the money that I'm making from my portfolio isn't sufficient for where I need it to be, but it can be by me selling out of those positions and putting it into something like an ETF that pays so say my portfolio yield at the time's 2%, but SCHD is paying 4.5%, and that 2.5% difference is all I need. What's to stop me from selling a quarter of my portfolio, putting it in SCHD, increasing my income, and then I'm good? Like, it might not even be I need to work longer. I can just transition into something that's a little bit higher yielding at that point, and I'm done.
Well, I'd look at the long-term capital gains tax that you would pay and then compare that to the higher percentage and see if it would even benefit you.
Yeah.
See what you're saying.
Yeah. So, I mean, that's my whole strategy. Like, pretend I did it with my whole portfolio. If my whole portfolio is $1 million and it's yielding 2%. I'm not good with numbers, but what is that? That's freaking $20,000 a year, I think.
I'd have to look at a calculator.
Yeah, we'll just make these numbers up. So $20,000 a year at $1 million. So if I'm yielding that, obviously that's not enough. Like $1 million is good, but that's a really low yield. 20,000, I can't live off $20,000. But if I were to sell that $1 million portfolio, obviously I would start transitioning earlier by turning off the drip and stuff like that. That way there's no more buys and any of my positions turn into long-term holds. That way it's long-term capital instead of short-term. But then at that point, if I were to sell that and put that into something that yields just say 8%, like say there's some quality ETF or something that's paying 8%, then I go from making 20,000 off of $1 million to 80,000 off of $1 million, which is way more possible that I could live off of 80 than I can 20. Now, 21 years from now, who knows what 80,000 will buy you? Probably nothing. But it's one of those things. So like, that's kind of the idea behind my portfolio. And ideally, I won't have to switch at all because my companies will grow. They'll grow fast enough. My yield on cost, which is what you're talking about, will actually be high enough to where like, oh, okay, I could go buy an 8% yielding company, but Visa's yielding me 13% right now because of my yield on cost. So like it's actually, I'd be losing money because of like Visa might only be yielding 0.7% by then, who knows? But to me, it's yielding 13% or whatever it is. So I don't know that I don't know that I follow yield on cost as much as other people do. Probably just because like I'm not at the point where I care. Like I just buy the company regardless of the yield. Like Costco has a really low yield too. I don't care. Like they just paid me a special dividend. That's not counted in that, so I like that part. I got $99.11 from Costco special dividend just for fun. I'm not
Yeah, I
mad at
wish
it.
I would. I wish I still held my Costco stock, but when I was new, I thought it was overvalued, so I sold it.
Yeah. Well, see,
But
there you go. That's
yeah,
both of the things that I'm afraid of is
yeah,
selling now. I'm really cautious to do that for tax purposes and the fact that like I've owned some really good. I sold Nvidia at like 400 and something a share, I think, or I don't remember what it
yeah.
was, but I bought Costco with it, so take that. But okay, so I think I have two more questions for you. So like, what are some investing or dividend related myths or misconceptions that you hear all the time that are just like flat out not true and like you want to debunk, like things that just people say that you're just like, that's not how that works?
I heard a guy say that, excuse me, that dividends don't matter,
Mm,
which I could see his point because if a company has free cash flow, they have three options. They can invest in research and development to make the company bigger, or they can invest in other assets to increase the company's size. They can do share repurchases, share buybacks, or they can pay the money out to the shareholders. I think a dividend is a sign of a company that pays a dividend is a sign of a healthy company that has free cash flow. And as long as the company's only goal isn't to just pay a high yield to attract shareholders and to become a yield trap, they're just trying to take care of their shareholders. I think dividends are fine.
well, and the a thing to think about with that is of those three options you mentioned, you don't have to just do one.
Yeah.
Like that's the thing with like companies with really low payout ratios, like a Microsoft or something like that. Like that's them saying, oh, okay, we're paying out 23%, whatever it is, 23% of our money as a dividend, but we're also going to do a buyback and we're also putting 64% of that money into research and development. So like
Yeah.
it's not like a one thing. It's not like, oh, okay, Microsoft's choosing to pay a dividend. Like that's what people think. That's actually expanding on your misconception is people think, oh, they're paying a dividend, they're done growing. That's not how that works. It's not
It's
100.
kind
They
of
don't have a
the
100% payout ratio.
it's kind of the all or nothing argument.
Yeah,
That
exactly. So
means,
it's exactly one of those things. So I like
yeah,
that you broke that down into the three things that they can do with their money. But there's literally something you can say bad about all three of them. It's just like literally which one's the most clickbaity is what people are talking about. Because like you can talk about okay, research and development. Just because you market something harder doesn't mean it's going to grow. Like it doesn't grow like oh I put more dollars in it. It means it's going to grow by more percentage. That's not how that works. You can also market smarter instead of harder, and like you can use small amounts of money to get good results instead of just throwing money. That's what the government does. They just throw money at something and hope it goes away. And here we are. But and then same thing with buybacks. Some people are like, "Oh yeah, buybacks are good. There's less shares outstanding, which increases my the EPS and all kinds of stuff for my company. That's good." But what if everybody thinks the company is overvalued? And then the company, because I never hear. So when Meta, now we can talk about it because they pay a dividend. But when Meta was getting its butt kicked last year, when they were in the year of efficiency, no, I didn't hear nothing about a share buyback. They were all putting all their money into research and development and efficiencies and all that stuff. But then they do really good. Their stock shoots up. They announce they're paying a dividend and they're doing a buyback. Why are they now they're doing a buyback? They didn't do a buyback when it was $110 a share. Now they're doing a buyback. I'm like, well, you missed your opportunity to do a buyback. That would have been better last year. So like you can
yeah,
argue that case too. So it's the devil's advocate thing, and it's very popular to do with YouTubers or whatever, where it's just like, okay, take this thing. What's the counter argument to that? And how can I argue the counter argument? Which is what that person's doing. Which to each their own. He's like I said, he's not wrong, but like I can literally sit here and argue against all three of the ways a way a company can spend their money.
yeah. I like what Buffett says. He says he doesn't look at it as buying a stock. He's buying. He looks at it as buying a company,
Mm-hmm.
shares of a good business, and holding it over time. I think people will be a lot more successful as investors if they look at it as buying good companies and never selling them. That kind of frame of mind.
Well, he uses the punch card approach or the punch card way of thinking all the time, where he's like, pretend
Yeah.
you have a punch card with 10 slots in it. That's all you get. He goes, when you buy a company, like it takes one of those slots and you don't get to, tape it back in there. Like it's gone. So like use them wisely. Because that's the idea. Like I only have 11 holdings. I don't know how many holdings that you said you had, but I have 11 holdings. 9 are active, 2 are dormant. That's it.
So I have 5 major holdings, and then this might sound kind of stupid, but if I like a company, I want to be a shareholder in it. So if I really like a company, sometimes I'll just buy one share just so I can say I own
Hmm.
a piece of that company.
So how many?
Yeah,
That means you have a lot of holdings.
I have about 25.
Okay, that's not too bad.
So
So like, what's your like? Are you buying one share as like a placeholder for that one to like keep evaluating it, or are you just buying like you said, like literally just buying it to say you own some of it?
uh, probably just to say I own some of it, like Berkshire Hathaway. I only own one share of the B.
Oh, I was gonna say you're rich
BRKB.
then, because that other one's like 400 and something
Yeah, the
thousand.
B. The only reason I bought the one share is so I could attend the annual shareholder meeting.
You need to buy the other one.
I've only got 129,000 right now. So.
So you're gonna sell your whole portfolio and buy that one when you're done, or what?
Nah.
That's who
I
knows what
think
that
Bill
would be.
Gates has a lot of the other one.
Yeah, there you go.
So
That's why I was gonna say. Well, and see, that's the thing too, is like that's like a barrier that doesn't exist anymore. Because back in the day, you had to buy whole shares.
yeah,
So now you could literally say, I want to own a little bit of everything, and you could put $1 into anything that you want to buy.
yeah.
And
Well, I
technically, you're a
usually buy
shareholder. So
whole shares.
yeah.
I'm not a real big fractional share guy. I
So
don't know. It feels weird.
do you like hold the cash until you get enough to buy a whole share, or what?
I usually have enough to buy a whole share.
So like when you said you add money to your portfolio like monthly or something.
Every paycheck, I try to put the majority of my paycheck into investing. I usually invest about I'd say 1,700 a month that goes into the stock market investing. It sounds crazy, but I don't know. I just want to be really wealthy.
Yeah, I mean that's not crazy. We do
Yeah,
2,000 a month for ours. Now the thing is, so in years past, I was maxing out the Roth ASAP. Typically by the
yeah,
end of April, I was maxed, and the wife was also maxed. The thing I was noticing now, it is ETFs, but the thing I was noticing is like, say the beginning of the year was really good for the stock market, and then like October through December was really bad. I was missing out on all those buys at good prices because I was already spent all my money in the stock or in my Roth IRA. So now this year, for the first time, I'm just adding, I think it's 583.33 or something like that. Gets you to the $7,000 a month or $7,000 yearly end. So like we're adding 2,000. We have 583.33 or whatever it is going into hers, 583.33 going into mine, and then the rest of the 2,000 goes into our taxable account. But that's only because we're saving for a house too. Like once we're done saving for the house, we're hyping that thing up. And I'm excited for it. So okay. So my question would be like, you add 17. You said 17 a month or a paycheck?
1,700 a month.
Okay, so 1,700 a month. What if you wanted to buy a share of Chipotle?
I mean they did the 50-for-1 split.
That already happen, or they just talked about that?
It already happened.
Oh, okay.
I don't know. I'm just not a real big Chipotle.
You said you like Joseph Carlson. You don't like Chipotle?
I mean, I have bought Texas
I was
Roadhouse.
gonna say, yeah, that's another
Yeah,
one
he
he talks
likes
about.
Texas Roadhouse.
Well, and
I don't know.
he's a Mastercard guy over Visa, so
Yeah, that kind of annoys me, but I don't know.
I mean,
He likes.
I honestly think they're the same thing. When I was deciding between the two, when every store I go to, when they say that they accept credit cards, Visa's always the first one on the sticker.
Yeah, it's kind of a duopoly, but I think Visa has a bigger moat. So
Yeah, I just think
it's
when
more
I think of
market
credit
share.
cards, like Visa's the first one that comes to my mind. Like anytime
Yeah,
somebody's like, "Oh, go get a Visa prepaid credit card," or from like Walmart or whatever, when they get like the little silver ones for Christmas or whatever. I've never seen a Mastercard one of those. I don't even know if
yeah,
they make those.
yeah.
So I don't
But
know.
um,
But yeah, so I like that. So I mean, at the end of the day, there's no right or wrong answer for like how many positions and stuff you have. I do think that's interesting the way you do it, where you just like you want to say you're an owner of something, so you just buy a share of it. That's pretty funny.
yeah, but I've done less of that. I'm trying to bulk up my Visa stake. Right now, I'm around 5,000 of Visa. I want to get it to my number one holding. You said something before we came on about plugging.
Yeah, go ahead. Actually, wait. I'm going to ask you one more question, then you can feel free to do any of that.
All right.
Okay, so the next question is, it's still 2024, so still today, whatever day it is, March 30th. Still March 30th. Market opens on Monday. You're all of a sudden 18 years old. You know everything you know today. So you're not going back in time, which is how people try to answer this question. Like, oh, I know NVIDIA is worth all this money. I'm going to buy NVIDIA. No, we're not doing that. So everything's the same price it is today. Markets are the exact same. The only difference is you're 18 years old. What tips do you give yourself? What do you do differently? What do you do the same?
I think the number one thing I would say is to stay humble and realize that no matter how much I learn, there's always more to learn. There's always more books to read. There's always more investment theses out there. It's to stay humble. I'm a philosophy major because I'm using it as a pre-law degree. I want to go to law school, and I think my favorite philosopher is Socrates. He always said, "The only thing I know is that I know nothing," and because of that, he believed he was smarter than everybody else. When I watch CNBC and all these pundits, the common denominator I see is they assert all of these propositions like it's all bulletproof, and they act like they know everything and they can never be wrong. You always want to leave room for the possibility that you might not be right.
Yeah, I agree with that. Like, and it's the thing of like, not so that expanding on that tip for your younger self would be to not beat yourself up over a decision you made today based off of knowledge you had today. Because a lot of times what we do is we learn things, and then 5 years from now we're like, I can't believe I was so stupid. Well, yeah, but you're judging your past decision off of what you know today. You didn't know that back then.
Yeah.
So like, I think that's really important. That's one thing that I've actually had to try to like understand for myself, because I've made a bunch of dumb mistakes in my portfolio, but like at the time I've justified it as why I made that mistake was based. Now, obviously there was still a path to not make that mistake or to make that mistake. I get that. But like based off the time the knowledge I had at the time, that was the more likelihood of being right, was that decision I made. Now it ended up being wrong, but it was still like a decision I made. So like expanding on what you said is like, don't beat yourself up over past mistakes based off of what you know today. That's not fair.
Yeah, I agree.
So I like that. But anyway, so Josiah, one, I want to again say thank you for reaching out. Again, say thank you for your service. Thank you for taking time to speak with me today. You said that you have stuff that you want to plug and shout out. Go ahead. This is your chance.
It'll be short. So the only social media I really have is LinkedIn. I have about 4,000 followers on there.
Oh, wow.
And I believe you talked about in the thumbnail, you'll have a link to it whenever this gets released. So yeah. My LinkedIn name is Josiah L, and it'll be a period after the L, and then Welch, Josiah Welch.
Okay, yeah, there we go. I haven't seen. That's a lot of followers on LinkedIn, man.
What's that?
I said that's a lot of followers on LinkedIn. That's pretty impressive.
Yeah, I'm hoping to get it up to 10,000, but we'll see what happens.
I've never even heard of somebody like using LinkedIn like that. That's pretty cool.
I don't think that's what it's for, but I don't care. I've heard Gary V talk about it, and I don't agree with him on everything. He's kind of crazy at times, Gary V. But he's saying how you can leverage LinkedIn as a platform, and he's got a point.
Well, I mean, it's networking.
Yeah, it's not working.
So, I mean, that's not a bad idea. So, yeah, make sure you guys go follow Josiah on LinkedIn. You'll send me that link after we get done here. I'll put that in the description down below the video. So yeah, again, Josiah, thank you. It was so much fun talking to you and hearing about your story. I hope you had a good time.
Yeah, I appreciate it, sir. Thank you, Troy.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.